Well, it's time now is for Money Monday, and today we're discussing the importance of reviewing your life insurance plan as life changes, Sean.
Yeah, that's right. President and CEO of Great Lakes Credit Union, our David Seeger, joins us to explain. David,
good morning, gentlemen. How are you today?
Yeah, good to see you.
Okay, we have the pre-markets this morning. It looks like we got some pre-market jitters here. We got the S&P down. We also have the Dow down as well, 37. It was 52 about an hour ago, so now it's starting to come back a little bit. There are some jitters from the numbers from last Friday for the employment.
Yeah, NASDAQ took a huge hit.
It did indeed. It did indeed.
2%.
So, yes. So we'll see what happens as the day progresses. Right now, a little shaky as we start out in the morning. Well, life insurance, boy, I tell you, necessary evil. You have to have it. But, you know, also a lot of people, they buy it and they forget about it. They don't do anything else with it. But you should review it from time to time. Well, some of the things you should review it for, particularly when you have these type of circumstances affect you in life. The number that of people that depend on you has changed. Either additional children or children becoming adults, and you no longer need to have them on a policy, whereas you need to reduce the total amount of face value of your policy because you don't have the same amount of exposure as you had before. Your child becomes disabled. In the event you have a child that has a permanent disability, you may want to buy a permanent policy for that child to carry them after you're gone and things of that nature. So it's always good to have those things in mind when you think about those type of situations, special circumstances. If you take a non-significant debt, maybe you have a business that you started and a bigger mortgage. So that's another reason to look at your insurance coverage, your life insurance coverage, to see if you need any more. You paid off significant debt. That's another reason to look at it as well. Well, maybe I don't need the same type of coverage anymore because I have paid down my mortgage or whatever the debt happens to be. So if I die, I don't need to replace that income because I don't have as much debt as I did before. You bought a policy prior to 2009. Now we're looking at mortality tables from 2001 versus 1980. We started using that in 2009, so people are living longer, so you can get a better rate because now it's different mortality tables to use. So look at that as well. And then check out your rating of your insurance company. Make sure that it is still a solvent company. There's a company called AM Best, and what they do nothing more but rate insurance companies, how strong they are and how safe they are. So check what their rating is. Anything below a A, you probably don't want to have. A minus, you don't want to have.
Because the last thing you want is to have to need that life insurance and then there's nothing there.
That's correct. That is correct.
Okay. Wow.
So the takeaway here is reevaluate.
Reevaluate, yes, from time to time.
Yeah. Wow. All right. Thank you very much, David.
You bet.